Investors Chronicle.
Welcome to the Companies and Market Show, Thursday the 28th of July as we record on what's been a big week for companies' news and results. Luckily, we found a spare half an hour to tear Julian Hofmann and Mark Robinson away from their desks, and indeed Dan Jones. Dan, what is coming up on the show today?
Hi, John. Yes, we have a deluge of results, which is very much in contrast to the apparent water shortage we have in this building right now. But we are starting with a couple of slightly older ones. We're starting with Unilever, and we're going to be discussing that and maybe a little look at Reckitt as well. Then we're talking about our cover story, which this week is on shares to fight inflation, or how to use shares to protect against the ravages of inflation. And then finally, we're going to return to some more results and look at some of the banks, Lloyds and Barclays in particular. Lovely
stuff. Well, before then, the news from the week. Fed rates rises continue. For the second consecutive month, the US's central bank has hiked interest rates by 0.75%. Fed Chair Jay Powell, however, soothed markets by saying the US central bank was open to the possibility of smaller increases in the future. Mark Zuckerberg's Meta, formerly Facebook, has reported its first ever year-on-year quarterly revenue decline. The April to June period saw profits down 1% from 2021 levels. Speaking to investors, Zuckerberg said, "We seem to have entered an economic downturn that will have a broad impact on the digital advertising business." Elsewhere in big tech, Microsoft and Alphabet shares rose 4% and 5% respectively off the back of solid, if unspectacular, results, while last week Twitter and Snap underwhelmed. Arthur Sants has a full tech write-up on the website and in the magazine. Shell has broken its profit record for the second consecutive quarter and announced a $6 billion share buyback scheme as the fallout from the war in Ukraine continues to generate bumper earnings. Low-cost airline EasyJet suffered a headline loss before tax of £114 million in the 3 months to June. That's despite a sevenfold increase in the number of passengers flown. EasyJet said that current capacity and cost impacts were a one-off limited to this summer. British American Tobacco has been forced to take a £957 million impairment charge linked to Russia's invasion of Ukraine. Despite this, financial performance has been solid through to the half year. And Rolls-Royce has appointed the former head of BP's downstream operations, Tufan Erginbilgic, as its chief executive from January next year. He will replace Warren East, who announced in February that he would step down after 9 years in the role. Quick look at the markets. FTSE 100 up around 1% in the past week, similar to how things have been going on Wall Street as well, also up around 1%.
Thank you, John. Yes, so on this possibly the busiest day of the year, company results-wise, we are going to start with one from a couple of days ago and then move into some of the more recent ones. We'll start with Unilever, which is a company that's attracted a lot of attention and discussion this year for a variety of reasons. But at its core, it is a company which is often cited as one that could do well in a time of high inflation, protecting margins. Mark Robinson, our company's editor, has looked at the interim results. How do you see that sort of from the top-down view to start with, Mark?
Well, what stands out for me, at least initially, and this applies to a few other companies that I've seen during the reporting season, is that they've been able to maintain those margins because of successful pass-through to a consumer base. Now, that came as something of a surprise. They've done this successfully, but the other side of the coin there is that they've had a decrease in volumes. And there must be a point at some point in the future when consumers will look to rival products or non-branded products, generics, so we can sort of reasonably expect there will be a trail-off in volumes as the year progresses. But for now, at least, Unilever, from an operational perspective, has performed well in that price pass-through. I guess another feature of the result as well is that I was looking for any mention really of ESG or stakeholder principles in there, and it was very difficult to find. So clearly, I think they've been stung by criticism that they've been paying far too much attention to wider social issues rather than just the operational activities within the company itself. I guess this might have something to do with the addition of Nelson Peltz to the board. He was the founder of Trian Fund Management, and he's got a reputation in the past of moving into underperforming companies and increasing efficiencies and earnings. So that may have concentrated minds. Plus, the company has come under a great deal of criticism from the market itself and people like Terry Smith, because he believes that they've taken their eye off the ball with relation to the day-to-day operations of the company.
I suppose this is a year which are really focus minds, concentrate minds. It is all about the margins at the moment. It is very much about trying to ensure that pass-through can be sustained, as you say. You think often with Unilever, distributors versus suppliers. Think of the likes of Tesco, I suppose, and the arguments they've had with Heinz recently. I think it was about 5-6 years ago they did have a similar dispute with Unilever itself over Marmite. You've got to imagine some of those conversations behind the scenes are fairly strong, shall we say, given both Unilever and Tesco do dearly, obviously, want to protect their margins at all costs at a time of double-digit food inflation. Do you think we'll see kind of more tensions coming on that front?
Almost certainly, because as I say, we it's very difficult to assess this, but there must come a point in the market where consumers do start considering alternatives. And given that inflation is running at 10% per annum, that point could be over the second half of this year, quite conceivably. It's a certain amount of irony as well, because you're talking about the dispute with Heinz, but they've also come unstuck with the Ben & Jerry's ice cream franchise as well, because of Ben & Jerry's sort of opposition to selling their products within the occupied Palestinian territories. And now I think they're actually taking Unilever to court over this matter as well, which is an incredible irony there, given that social provisions have been a big part of their selling point for Unilever. Why, I don't know, but that's where things stand at the moment.
Yeah, and they are a subsidiary of Unilever, so yeah, there clearly are internal tensions as much as anything else at the moment. The trading down is an interesting issue, isn't it? I know we've spoken about this a little bit in the last few weeks about Haleon, the new spin-off of from GSK, which of course Unilever did try to buy, which is another thing that rubbed shareholders up the wrong way, I think, earlier this year. With those kind of products, medical, Panadol, those kind of things, there's maybe a sense that trading down is harder to do. People, if they're unwell, will still kind of cling to the brands they know best. But when it comes to food staples, maybe that's something that's less resilient. They'll think, well, I'll just buy the supermarket owned Marmite, that kind of thing. So it will be interesting to see what happens there.
Yeah, the psychology behind these things is quite interesting as well. And I actually wrote up results for Diageo this morning too, and there's a kind of counterintuitive strand in there, because they seem to have they've done very well on the price pass through, and their costs linked to glass, for instance, which is very energy intensive to produce, plus rising grain costs. They managed to keep their consumers online, keep them buying through the process of premiumization, which is a dreadful word. I can't even say it without stuttering. But it just means actually that consumers, even given the wider economic downturn, are actually willing to go upmarket in terms of some products. Usually, I refer to it as lifestyle luxuries in the article, and there's plenty of anecdotal and statistical evidence to support this view as well, that even during economic woes, people are prepared to pay a little bit extra for things that make them feel better or just distract them from the wider problems. And that's evident in Diageo's results today. The only caveat I put in there is that in relation to that company in particular is that we don't really know what's going to happen to grain prices in the early part of next year, but the portents aren't encouraging.
I think Reckitt as well is another one, obviously reported in the past few days, where again it's been able to pass through pretty hefty double-digit almost price increases, which just kind of shows I suppose the brand strength there. And look at all three of these companies, Unilever, Reckitt, Diageo, they are the classic kind of inflation plays in a way where they're never going to shoot the lights out, but they will. The idea being they'll provide some resilience, and so far, even with inflation at the levels we're seeing, results seem to be bearing that out. So that is good news for investors, I suppose, in terms of those kind of classic plays. Which brings us to our cover story this week, which is on this very subject. And it's on the question of how investors should think about inflation, what kind of things they should be looking for. I mean, the ability to pass on prices is one thing, but that's far from the only consideration people should be looking at. And of course, there are differing opinions as to how successful these things will be in the long term and what kind of companies you should be examining. Is that fair to say, Julian? You've written this piece.
Yeah, I've put together my semi-annual essay on inflation, which I seem to come around to on a regular basis. It's an interesting topic because there are certain totems about how you should invest during a time of inflation, and it tends to get trotted out every time we have a bout of it. It's always like you should get involved in utilities because they're monopoly providers. They can pass on costs to customers quite easily. But the thing I found when I looked at it in more detail is that a lot of those truths, firstly, they're kind of spouted by people who have no personal experience of what investing during inflation actually looks like. Because we haven't really had anything significant for 30 years or more. And secondly, you still have to avoid the value traps and the overpriced expectations of earnings that apply even when we don't have inflation. So I tried to steer a path in the piece by looking at how companies actually react at a granular level to coping with their supply chains, pricing increases in their supply chains. And it came up with some interesting results. I mean, we talked about Diageo's results, and there I would argue a classic case of how a company can respond because effectively they have the pricing power to protect their margins. I mean, the key point here is always protecting the profit margin. It's not really to do with revenue growth at the moment. Yeah, it seems to me that was the route to go rather than down this idea, we'll look for inflation-linked monopoly providers, which I think is a bit of a fallacy, if only because those kind of companies, particularly in the UK, were only privatized at a time when there wasn't really high levels of inflation, or at least not to what we're seeing at the moment, or in the 1970s. Yes, I tried to bring that all together in a more systematic way, really.
Yeah, I think, as you say, we discussed this staples resilience, and that is one go-to, which does seem to be putting the proof behind the pudding at the moment. But utilities, as you say, is an interesting area because there's maybe more doubts there, and I suppose even widening it out today. You look at the results of Centrica, already attracting a lot of opprobrium for doing well at such a time, and that that kind of political risk is there with these shares, even if they do have qualities to the company which can deliver in these kind of times.
Well, I think I made that point in the piece, is that the reason why pension funds like those kind of shares, for instance, is because they have a very stable level of dividend payout. But I mean, I think our argument is that's more a compensation for regulatory risk rather than any reflection on their ability to price things, because you never know. I mean, it's happened a couple of times in the past, but you never know when the government's regulatory regime with those kind of utilities is going to change, or they could impose a windfall tax. I mean, that's the other thing that's dragging the shares. So you have to sort of take a step back and actually look at companies that have got that ability to price. I mean, that seems to be the differentiator in terms of inflation resilient shares. So yeah, I mean, Diageo is one example. We looked at a couple of others which people can read in the piece, but it really does go back to that going back to first principles. It's not, the problem is if you try to set out to do something, you'll inevitably misprice what you're trying to buy, because you end up you might go after inflation on its own, but then you end up overlooking, well, what's the actual quality of the earnings, or how good is the management, for example. That tends to be a question that gets forgotten in these things. So the way I've tried to look at it is how to assess a company in the round rather than sort of trying to chase one aspect of it.
It's a good point. We should be careful not to let the tail wag the dog in these things, despite the fact that inflation is one of those, or perhaps the only thing where it's so all-pervasive that it can be hard to see the forest for the trees sometimes. As Julian says, you can find out more details in the magazine this week. It is the cover story. There are a couple of other specific companies mentioned there, as well as a lot of detailed thinking about inflation and how to think about it in the round. Let's move on to some more results. We can't ignore too many of them. There are so many this week. We're going to look at banks, though, in particular, to conclude today. Barclays reported today, which we'll come to in a minute, but Lloyds, a very different member of the UK Big Four, reported a few days ago, and some promising signs there, Julian.
Yes, Lloyds, or the Black Nag, as we like to call them. It's one of those shares where investors don't tend to give it a lot of credit. So it sort of bubbles away underneath the surface and then comes through with a decent performance, but then it never seems to get the recognition that deserves. The main thing, though, with those type of shares, and Lloyds in particular, is that it's become so huge in terms of the mortgage market in the UK that it's almost a proxy, really, for taking a view on the UK's economy generally, but also particularly the housing market. It's almost so vast that you just almost have to be wary of it. So I think that would be the message to come across from that. But I mean, their operating performance was very good. I mean, they took out, they're on course to hit their cost target for the year, which is about 8.8 billion. The net interest margin, which is the essential cost of capital versus what they're lending out, has gone up quite reasonably, but obviously that's related to the Bank of England's views on interest rates. So you can they've picked up a net interest margin of 2.8%, which is 3 basis points higher than this time last year. So the regulatory, the general environment seems to be moving in their favour, if that makes any sense. And you can't really argue with the overall picture. It's just whether with Lloyds, whether it's worth the time for investors. I think that's the difficult question to ask. It's sort of like it's the creation of this gigantic merger in 2008, well, forced merger, and it's almost like it can't go anywhere. I think it hangs a question over its worth, what it's worth for investors, if I'm being honest. But eventually they might end up paying up quite high dividends if they can get the payouts back to their previous level. So there might be a certain income attraction, but I don't think the shares are going to go very fast, very quickly. I think that's my basic conclusion. But I mean, you've got to give it to them. They did put in a decent second quarter performance, particularly.
I suppose it's the story of the past, as you say, the past decade, almost 15 years now. I won't say utility-like because we've just been discussing some of the downsides of utilities, but yeah, this kind of relatively anodyne performance. The rising rate environment for a retail bank like Lloyds is obviously beneficial, but as we've seen, I suppose, in the share price moves of the past few weeks, the question now is, as you say, whether that benefit will be offset by a slowing, economy, a slowing housing market, problem for mortgages slightly further down the line, a few months down the line. So it's one of those relatively intractable questions, I suppose.
I mean, you almost wonder whether they would do better as a company and therefore be more interesting if they were smaller. I think that's the one paradox you find in it, that it just doesn't move anywhere very fast. And I don't think as an investor you're ever going to make a lot of money out of them, really.
Yeah.
At least in their current form.
Yeah. Well, as you say, the 2008 merger was forced upon them, rather, but they are where they are, and they may well remain there for a while. Let's talk about Barclays, which is obviously a very different kind of bank, and always has the odd, how should we say, if not crisis, then the odd alarming episode. Or there are evidence of such things in the results today as well.
Yeah, it's Barclays, the stuffed chicken. By contrast, it's a very strange hybrid of mortgage bank and this kind of racier investment bank, and it seems to be that the investment bank, as we saw in the results today, keeps causing them issues that suddenly pop out of nowhere. It's almost like it's a black box operation. And the last thing that went disastrously wrong was that they overissued a load of securities based to American investors that were based on some of their oil and oil ETFs or something. Forward contracts, things like that. That cost seems to have escalated, certainly in terms of legal fees. So in the statement, they're saying that their legal fees now are something like 400 million that they're on the hook for. The overall impact was something like 600 million from the quarterly profit. So it's definitely quite material for them. But again, their performance wasn't bad. I mean, the UK business is holding up, and their net interest margin is going up along with everyone else because of the Bank of England's rate increases. It seems to be compensating just about for the sort of lagging investment bank, but as soon as you get further in the cycle, it's the investment bank that then does really well, and it sort of compensates for this kind of slightly more pedestrian UK business. But I mean, it's a Marmite share. I mean, no pun intended when we were talking about Unilever. But you either take it as read that there's always going to be trouble with the investment bank somewhere down the line, and you take that risk and you accept the fact that the shares are very, very cheap. I mean, you can pick them up for sort of 5-6 times earnings, which is a discount even to any of their peers, really.
The structured note debacle is interesting. It does seem I think there's an internal report being commissioned, so I'm sure all the grisly detail will come out in due course. But it does seem, from what I've seen, it's effectively an administrative error in that they forgot to update an internal system which, allows them to issue a certain number of products up to a certain limit. They forgot to update that, so they kept issuing them. They realised several years later they were several millions or billions over that limit, and now it's costing them and shareholders a lot of money, which, it may all stem due to one person in accounts who left or something,
It could be that. I mean, also the embarrassing thing is that the current CEO was in charge of that particular division,
the risk division. Yeah,
exactly. So it's not a happy story. But if you take it as if you take it that is always going to be the story with Barclays, then you can accept the risk in the shares. I mean, whether they're ever going to make a lot of money again in terms of for shareholders again is a moot point. But if you can accept that there's always going to be a problem, then it'll be fine in the long term. But it's one of those, the banking sector generally it's still a sort of zombified relic of what it was in the early 2000s, really. I think that's the easiest way to describe it.
We should just mention the other probe which they've taken provisions for, which is quite a curious one as well in the US, looking at staff using personal devices for company business. It seems to mainly centre around people using WhatsApp to speak to their colleagues, which is encrypted, but obviously it's not a company phone or a company device, and that seems to be something that a lot of the big investment banks in the US are taking provisions for at the moment. Quite a curious regulatory probe there, but we'll see how long that goes on. Mark, I don't know your thoughts about the banking sector. Would you echo Julian's thoughts? It's tough to see it excelling even in a higher interest rate environment at the moment.
Yes, you're going to see sort of reduced activity on the commercial lending front as well, which will have an impact. I mean, it's interesting with Julian talking about Barclays before. It seems that this latest scandal in the US was wholly avoidable. This comes down to governance issues, operational issues itself. Even with rising interest rates, it's difficult to think that they're going to perform that well in the market. And it's been a long time since they were seen as having wholly defensive characteristics as well. Yes, I'm slightly negative on the banks, even though we're likely to enter into a recession shortly.
Yeah, I mean, obviously that has its downsides as well for banks as much as any of us. But yeah, we will see. Maybe one day the sector will thrive again. Obviously, you have the challenger banks, Julian. I don't know what your thoughts are about their, more of the same, really. They're still in the same sector after all. How do you sort of see those companies?
They're interesting. I mean, they're definitely taking market share. I mean, myself, I've switched over to a challenger bank really from a high street major. I mean, their whole offering is all about easy customer service. I don't know yet whether they'll have scale. It'll take a long time, I think, before they achieve scale. And you might see a few of them merge in order to achieve that. Basic banking is expensive. I mean, there's no question about it. But I mean, their advantage, of course, is that they don't have all the physical infrastructure that the big high street majors are still lumbered with. So they can, relatively cheaply set up their operations. And they seem to be specializing in certain markets. So you've got one or two that are ethically driven. So they can market to that kind of depositor. There are others who are sort of beloved of millennials. They seem to have quite a slick sort of marketing brand. Everything sort of phone use. You do everything through a phone, for example. That seems to appeal to quite many young customers. But it's going to be a long time, I think, before they they're a serious threat, but they're definitely there in the background. And I think some of the moves you see at the main banks is a response to that, as there's a definite feeling that they have to reorganize some of their operations if they're not going to at some point in the future be overtaken.
There's no doubt about that as well. I've got friends that are working in Lloyds at the moment, and there is such an onus there on improving their digital product range as well. And we've got to remember as well that the challenger banks, many of them don't offer a full server, that provide a full service offering. So they may struggle in that regard. But the way that it's going forward, as you just mentioned there, younger people have no compunction about using their phone to conduct their online banking. That's definitely the way forward. And the likes of Lloyds and Barclays are already demonstrating that they're trying to throw off those legacy costs. You imagine over time that their fixed cost base will reduce as well. And that is, as you say, partly a reaction to the onset of the challenger banks.
Yeah, I mean, nobody misses queuing in a bank branch at lunchtime. I think that's the...
No.
If you sort of go back 10 years, that's what you had to do.
Yeah, I think we can certainly thank the challengers perhaps for improving the customer service at the Big Four as well as for their own customers. But whether shareholders see equivalent improvements remains to be seen as ever. That does bring us to the end for today. Thank you to Julian and to Mark for taking time on this busy results day. And thank you to you for listening. We'll be back next week with another Companies and Markets show.